Based upon what Steve just said, glide path is what I think of. The Fed's on a glide path.
Glide path. Remember, we had someone on the show.
There was some cat that came on the show. He told us what his nickname was, and that was probably the worst thing he ever did in his life.
You don't ever make up your own nickname. So
what is it?
And what we heard from Steve was what we were hearing from the Fed. It's kind of what you're just telling me about the economy. It's kind of like when your accountant says you're paying more taxes, so you should be happy. If the economy is doing better and the Fed actually has to hang in the pocket longer and be more hawkish, this was obviously what the message was today. The question is, when the Fed says soft landing is not our baseline expectation, which is the point they made very clear, is that they don't have to see a soft landing? Look, we know what their mandate is, right? Their mandate is inflation and growth and essentially full employment. And so where does that leave the economy? I think that the Fed has no idea where the data is going. And I think that these comments today were very hawkish. They took 50 bips off of next year in terms of the ease that was expected. That's hawkish. But I think they have no idea. And I think the data that's coming through, they upgraded the economy. They upgraded the labor. And again, these are relative to where they were before. And I think, frankly, we have no idea where we're going to be in 3 months.
It seems like the situation now is the economy is in a good spot. So is the Fed having an easier time or a harder one with this?
Well, first, I'm going to channel my inner Sonny Corleone and say, can you believe how hawkish the Fed was on Dan Nathan's birthday?
Oh, Dan Nathan's birthday. Happy birthday.
Yeah, thanks.
That was good. You liked it, didn't it?
Yeah, you snuck it right in.
No, I mean, let's not confuse the issue. The Feds, they should not declare victory of any. By the way, they're trying to solve the problem that they created in the first place. And if I seem a little animated, it's because I am. I mean, they've gotten it all wrong all along, and they probably will continue to be as hawkish as they possibly can be into early next year. The market doesn't anticipate that. Look at the late move in HYG today. It fell off a cliff as 10-year yields are now in the aftermarket almost 4.4%. Neither one of those are bullish for stocks. So if we're looking at it through the lens of the stock market, this is not a good thing. Higher rates are not good for stocks.
Yeah, through the lens of the stock market, it's kind of interesting. Look at it year over year. The 10-year U.S. Treasury yield a year ago on my birthday was 3.4%. Now it's 4.4%. You just said making 16-year highs. Look at what crude's done year over year. Look at what the dollar. Now, it's a little bit higher there. It's been obviously pretty volatile. I mean, the one thing to me that is interesting that sticks out like a sore thumb is the S&P 500 where it is. A year ago today, the S&P was at 3,800 or so. And you think about that, and I see this scenario for a soft landing, but when you think about the lag effect of all of this policy, right, that they've done over the last 18 months, I say to myself, something has to give. We have a 15 VIX now. A year ago, we had a 25 VIX. I just feel like we've just been very complacent here, and I think about some of the moves that we've had in some of the biggest stocks in the stock market. Apple today was down 2%, Microsoft down 2.5%. Both of them are down 11% from the all-time highs made in July. The semiconductor index on a relative basis has not made new highs. The QQQ, the NASDAQ 100, appears to be rolling over a little bit. And I'm not even done. We can go beyond tech. We can look at the transports are not trading particularly well. Industrials are not trading particularly well. I think we have a situation where the S&P and the NASDAQ, I think, as a monolith, are kind of masking a lot of bad performance under the hood in the stock market.
What's curious, Karen, 2 years ago, on this day, your birthday 2 years ago, 30-year fixed-rate mortgages were a hair over 3%, like 3.02% or something like that. Today, they're pushing 7.3%, more than double. The housing market has remained resilient. The stock market has remained resilient. For now, fair enough. Everything's a cycle. But even the stock market's remained resilient, given 500 basis points worth of interest rate tightening. What exactly derails this if those things didn't?
Well, something's got to give. I think, though, to the housing thing, because the market's rigged. There's no, anybody with a mortgage isn't selling. So you have this sort of unusual situation of not as many houses for sale. I do think, though, the thing that's got to give is the market. To Guy's point, rates are higher, which should mean equity's lower. I mean, it's just math, equity risk premium. And so I feel that I want to be hedged in the more high flyer names that I have. So things like the IGV or short the Qs, things like that. But I'm always long, though. I'm net long for sure. So I think it's going to be painful.